Your Home Loan Toolkit, a step-by-step guide from the Consumer Financial Protection Bureau. So how can this toolkit help you? Buying a home is exciting and, let's face it, complicated. This booklet is a toolkit that can help you make better choices along your path to owning a home. After you finish this toolkit, you'll know the most important steps you need to take to get the best mortgage for your situation. You'll better understand your closing costs and what it takes to buy a home, and you'll see a few ways to be a successful homeowner. So choosing the best mortgage for you. You're starting to look for a mortgage, or you want to confirm that you made a good decision. To make the most of your mortgage, you need to decide what works for you and then shop around to find it. In this section, you'll find 8 steps to get the job done right. Number 1, define what affordable means to you. Only you can decide how much you are comfortable paying for your housing each month. In most cases, your lender can consider only if you are able to repay your mortgage, not whether you will be comfortable repaying your loan. Based on your whole financial picture, think about whether you want to take on the mortgage payment plus the other costs of home ownership, such as appliances, repairs, and maintenance. So have the talk. Talk to your spouse, a loved one, or a friend and kind of define what affordable means to you. Know your numbers. So this is a nice form to be able to print out and use to calculate the home payment that you take on by filling the worksheets below. Think about what an affordable home loan looks like for you. These worksheets can help. First, estimate your total monthly home payment. Second, look at the percentage of your income that will go towards your monthly home payment. And third, look at how much money you will have available to spend on the rest of your monthly expenses. So print this form out and fill it out. Number 2, step 2, estimate the percentage of your income spent on your monthly home payment. So calculate the percentage of your total monthly income that goes towards your total monthly home payment each month. A mortgage lending rule of thumb is that your total monthly home payment should be at or below 28% of your total monthly income before taxes. Lenders may approve you for more or less depending on your overall financial picture. So print this form out, do the math, and see what you're comfortable with in the end. Number 2, understand your credit. Now your credit scores, and how wisely you shop for a loan that best fits your needs have a significant impact on your mortgage interest rate and the fees that you pay. To improve your credit and your chances of getting a better mortgage, get current on your payments and stay current. About 35% of your credit scores are based on whether or not you pay your bills on time. About 30% of your credit scores are based on how much debt you owe. So that's why you might want to consider paying down some of your debts. Now you can get a copy of your credit report through annualcreditreport.com. Get a copy of that and check it for errors. If you find mistakes, you can submit a request to each of the credit bureaus asking them to fix the mistake. So for more information about correcting errors on your credit report, visit consumerfinance.gov/ask-CFPB. Now, if your credit score is below 700, you'll likely pay more for your mortgage. Most credit scoring models are built so that you can shop for a mortgage within a certain period, generally between 14 days and 45 days, with little or no impact on your score. If you shop outside of this period, any change triggered by shopping should be minor, and it might be a small price to pay for saving money on a mortgage loan. Now in the future, if you work on improving your credit and you wait to buy a home, you will likely save money. Some people who improve their credit save $50 or $100 on a typical monthly mortgage payment. An average consumer who adopts healthy credit habits, such as paying bills on time and paying down credit cards, could see a credit score improvement in 3 months or more. So number 3, pick the mortgage type, fixed or adjustable, that works for you. With a fixed rate mortgage, your principal and interest payments stay the same for as long as you have your loan. Consider a fixed rate mortgage if you want a predictable payment. You may be able to refinance later if interest rates fall or your credit or financial situation improves. With an adjustable rate mortgage or an ARM, your payment often starts out lower than with a fixed rate loan, but your rate and payment could increase quickly. It's important to understand the trade-offs if you decide on an ARM. With an ARM, your payment could increase a lot, often by hundreds of dollars a month. Make sure that you're confident that you know what your maximum payment could be and that you can afford it. So if you're planning to sell your home in a short period of time, well, that might be one reason that some people would consider an ARM. But you probably shouldn't count on being able to sell or refinance. Your financial situation could change, home values may go down, or interest rates may go up. You also need to check for risky loan features. So some loans are safer and more predictable than others. It's a good idea to make sure that you are comfortable with the risks that you are taking on when you buy your home. You can find out if you have certain types of risky loan features from the loan terms section on the first page of your loan estimate. A balloon payment is a large payment that you must make, usually at the end of your loan repayment period. Depending on the terms of your loan, the balloon payment could be as large as the entire balance of your mortgage. And a prepayment penalty is an amount that you have to pay if you refinance or pay off your loan early. A prepayment penalty may apply even if you sell your house. 4, choose the right down payment for you. A down payment is the amount that you pay towards the home yourself. You put a percentage of the home's value down and borrow the rest through your mortgage loan. So decide, do you want to put 20% or more down? And what that means is a 20% or higher down payment likely provides the best rates and most options. However, think twice if the down payment drains all of your savings. Will you put down between 5 and 19%? Well, you probably will then have to pay higher interest rates or fees. Lenders most likely require private mortgage insurance, or PMI. PMI is an insurance policy that lets you make a lower down payment by insuring the lender against loss if you fail to pay your mortgage. Now keep in mind that when you hear about no PMI offers, that doesn't mean zero cost. No PMI offers often have higher interest rates and may also require you to take out a second mortgage. So be sure that you understand those details. Or there's another option, I will make no down payment or a small one of less than 5%. Low down payment programs are typically more expensive because they may require mortgage insurance or a higher interest rate. Look closely at your total fees, interest rate, and monthly payment when comparing options. So ask about loan programs such as conventional loans that may offer low down payment options, or FHA, which offers a 3.5% down payment program, VA, which offers a zero down payment option for qualifying veterans, or USDA, which offers a similar zero down payment program for eligible borrowers in rural areas. Now, the advantages of prepayment is that when you make additional mortgage payments so that you can pay down your mortgage early, this reduces your overall cost of borrowing. So you may be able to cancel your private mortgage insurance early and stop paying the premium. Especially if your down payment is less than 20%, it may make sense to make additional payments to pay down your loan earlier. 5, understand the trade-off between points and interest rate. Now, points are a percentage of a loan amount. For example, when a loan officer talks about 1 point on a $100,000 loan, The loan officer is talking about 1% of the loan, which equals $1,000. Now, lenders offer different interest rates on loans with different points. There are three main choices that you can make about points. You can decide that you don't want to pay or receive points at all. This is called a 0-point loan. You can pay points at closing to receive a lower interest rate, or you can choose to have points paid to you, also called lender credits, and use them to cover some of your closing costs. The example below shows the trade-off between points as part of your closing costs and interest rates. In the example, you borrow $180,000 and qualify for a 30-year fixed rate loan at an interest rate of 5.0% with 0 points. Rates currently available may be different than what is shown in this example. So here's three scenarios of how points can affect the interest rate, ultimately the payment. Number 6, shop with several lenders. You've figured out what affordable means for you. You've reviewed your credit and the kind of mortgage and down payment that best fits your situation. Now is the time to start shopping seriously for a loan. The work that you do here could save you thousands of dollars over the life of your mortgage. So gather some facts and compare costs. Make a list of several lenders that you will start with. Get the facts from the lenders on your list. Get at least 3 offers in writing so that you can compare them. And then compare total loan costs. So loan costs can vary widely from lender to lender, so this is one place where a little research may help you save a lot of money. Ask a real estate and title professional about average costs in your area. And you can learn more about loan costs and get help comparing loans at consumerfinance.gov/owning-a-home. Talking to different lenders helps you to know what options are available and to feel more comfortable in control. Here is one way to start the conversation. So this mortgage is a big decision and I want to get it right. Another lender is offering me a different loan that may cost less. Let's talk about what the differences are and whether you may be able to offer me the best deal. Number 7, choose your mortgage. Well, you've done a lot of hard work to get this far. Now it's time to make your call. So confirm your decision. I can repay this loan. I am comfortable with my monthly payment. I shopped enough to know that this is a good deal for me. There are no risky features such as balloon payment or prepayment penalty I can't handle down the road. And I know whether my principal and interest payment will increase in the future. Now, intent to proceed. When you receive a loan estimate, the lender has not yet approved or denied your loan. Up to this point, they are showing you what they expect to offer if you decide to move forward with your application. You have not committed to this lender. In fact, you are not committed to any lender before you have signed final closing documents. Once you have found your best mortgage, the next step is to tell the loan officer you want to proceed with that mortgage application. This is called expressing your intent to proceed. Lenders have to wait until you express your intent to proceed before they require you to pay an application fee, appraisal fee, or most other fees. Rate lock. Your loan estimate may show a rate that has been locked or a rate that is floating, which means it can go up or down. Mortgage interest rates change daily, sometimes hourly. A rate lock sets your interest rate for a period of time. Rate locks are typically available for 30, 45, or 60 days, and sometimes longer. Now, the interest rate on your loan estimate is not a guarantee. If your rate is floating and it is later locked, your interest rate will be set at that later time. Also, if there are changes in your application, including your loan amount, credit score, or verified income, Your rate and terms will probably change too. In those situations, the lender gives you a revised loan estimate. There can be a downside to a rate lock. It may be expensive to extend if your transaction needs more time. A rate lock may lock you out of better market pricing if rates fall. So here's some questions that you can ask your lender. Eight, avoid pitfalls. What not to do. Don't sign documents where important details are left blank or documents you don't understand. Don't assume that you are on your own. Don't take on more mortgage than you want or can afford. Don't count on refinancing, and don't take out a loan if you already know you will have to change it later. Don't fudge the numbers or the documents. And don't hide important financial information. And here are the reasons why. You're agreeing to pay a substantial amount of money over an extended period of time. Make sure you know what you're getting into and protect yourself from fraud. Now, HUD-approved housing counselors can help you navigate the process and find programs available to help first-time home buyers if you need help. Now, make certain that you want the loan that you are requesting and that you're in a position to live up to your end of the bargain. If you're not comfortable with the loan offered to you, ask your lender if there's another option that works for you. Keep looking until you find the right loan for your situation. You are responsible for an accurate and truthful application. Be upfront about your situation. Mortgage fraud is a serious offense, and hiding negative information may delay or derail your loan application. So how to handle problems. So what happened? I have experienced a problem with my loan application or how my loan officer is treating me. So ask to talk to a supervisor. It may be a good idea to talk to the loan officer first, and if you're not satisfied, ask to speak with a supervisor. So I think it was unlawfully discriminated against when I applied for a loan or when I tried to buy a home. Well, under the Fair Housing Act and Equal Credit Opportunity Act, those two acts prohibit housing and credit discrimination. So if you think you've been discriminated during any part of the mortgage process, you can submit a complaint and describe what happened. I have a complaint. Well, submit a complaint to the Consumer Financial Protection Bureau if you have problems at any stage of the mortgage application or closing process. Or later if you have problems with making payments or become unable to pay. I think I may have been the victim of a predatory lender or loan fraud. Well, don't believe anyone who tells you they are your only chance to get a loan or that you must act fast. Learn the warning signs of predatory lending and protect yourself. Now we're at the point. You're closing. You've chosen a mortgage. Now it's time to select and work with your closing agent. Once you've applied for a mortgage, you may feel like you're done. But mortgages are complicated and you still have choices to make. So shop for mortgage closing services. Once you've decided to move forward with a lender based on the loan estimate, you are ready to shop for the closing agent, who gathers all of the legal documents, closes the loan, and handles the money involved in your purchase. This is typically the escrow company in our state. Before you apply for a loan, your lender gives you a list of companies that provide closing services. You may want to use one of the companies on the list, or you may be able to choose companies that are not on the list if your lender agrees to work with your choice. The seller cannot require you to buy a title insurance policy from a particular title company. Closing agent. In most of the country, a settlement agent does your closing. In other states, particularly several states in the West, the person is known as an escrow agent. And in some states, particularly in the Northeast and South, an attorney may be required. When you compare closing agents, look at both cost and consumer service. Ask your real estate professional and your friends. These people may know companies they would recommend. Be sure to ask how that company handled problems and if they have a good reputation. Review the list of companies that your lender gave you. Select a few companies on the list and ask for references from people who recently bought a home. Ask those people how the company handled problems that came up during the transaction. Title insurance. When you purchase your home, you receive a document most often called a deed, which shows the sellers transferred their legal ownership or title to the home to you. Now, title insurance can provide protection if someone later sues and says they have a claim against the home. Common claims come from a previous owner's failure to pay taxes or from contractors who say they were not paid for work done on the home before you purchased it. Most lenders require a lender's title insurance policy, which protects the amount that they lent. You may want to buy an owner's title insurance policy, which protects your financial investment in the home. The loan estimate you receive lists the owner's title insurance policy as optional if your lender does not require the policy as a condition of the loan. Depending on the state where you are buying your home, your title insurance company may give you an estimated and itemized list of fees at closing. This itemized list may be required under state law and may be different from what you see on your loan. Your loan estimate or closing disclosure. That does not mean that you are being charged more. If you add up all the title-related costs your title insurance company gives you, it should match the totals of all the title-related costs that you see on your loan estimate or closing disclosure. When comparing costs for title insurance, make sure to compare the bottom line total. Home inspector and home appraiser. When you're considering buying a home, it is smart to check out carefully to see if it's in good condition. The person who does this for you is called a home inspector. The inspector works for you and should tell you whether the home you want to buy is in good condition and whether you are buying a money pit of expensive repairs. Get your inspection before you are fully committed to buy the home. A home inspector is different from a home appraiser. The appraiser is an independent professional whose job is to give the lender an estimate of the home's market value. You are entitled to a copy of the appraisal prior to your closing. This allows you to see how the price that you agreed to pay compares to similar and recent property sales in your area. 2. Review your revised loan estimate. When important information changes, your lender is required to give you a new loan estimate that shows your new loan offer. It is illegal for a lender to quote you low fees and costs for its services on your loan estimate and then surprise you with much higher costs in a revised loan estimate or closing disclosure. However, a lender may change the fees it quotes you for its services if the facts on your application were wrong or changed, or you asked for a change, or your lender found you did not qualify for the original loan offer, or your loan estimate expired. Here are common reasons why your loan estimate may change. You decided to change the loan program or the amount of your down payment. The appraisal on the home you want to buy came in higher or lower than expected. You took out a new loan or missed a payment that has changed your credit. Your lender could not document your overtime bonus or other income. So again, have the talk. If the loan estimate is revised, you should look it over to see what changed and then ask your lender these questions. Three, understand and use your closing disclosure. So you've chosen a home that you want to buy and your offer has been accepted. You've also applied for and been approved for by a mortgage. Now you are ready to take legal possession of the home and promise to repay your loan. At least 3 days before your closing, you should get your official closing disclosure, which is a 5-page document that gives you more details about your loan, its key terms, and how much you are paying in fees and other costs to get your mortgage and buy your home. Many of the costs you pay at closing are set by the decisions you made when you were shopping for a mortgage. Charges shown under services that you can shop for may increase at closing, but generally by no more than 10% of the costs listed on your final loan estimate. The closing disclosure breaks down your closing costs into 2 big categories: your loan costs and other costs. Your loan costs First is the lender's origination cost to make or originate the loan, along with any loan application fees and fees to underwrite your loan. Underwriting is the lender's term for making sure your credit and financial information is accurate and you meet the lender's requirements for a loan. Under other costs, you have property taxes and your homeowner's insurance premiums and flood insurance if required. So what is your closing disclosure? It's a 5-page closing disclosure that sums up the terms of your loan and what you pay at closing. You can easily compare the numbers to the loan estimate you received earlier. There should not be any significant changes other than those you have already agreed to. So take out your own closing disclosure or review the example here. Double check that you clearly understand what you'll be expected to pay over the life of your loan. So on page 1, you got your loan terms, your costs at closing. Page 2 are your total loan costs and your prepaids. Escrow. On page 3, calculating cash to close and summaries of transaction. On page 4 are the loan disclosures. Page 5 is the finance charge and what the annual percentage rate of your loan is, which is your total cost of credit, stated as a rate. Now that you've spent some time understanding what you need to do and what you need to pay as a new homeowner, now is the time to step back and feel sure that you want to proceed with the loan. In the future, if you're not comfortable with your mortgage and your responsibility to make payments, you might not be able to keep your home. If you've made a careful decision about what you can afford and the mortgage you want, you will be able to balance owning your home and meeting your other financial goals. Now, owning your home. Now that you've closed on your mortgage and the home is yours, wow, ownership is exciting, and your home is also a large investment. So here's how to protect that investment. Act fast if you get behind in your payments. Contact your mortgage servicer right away. To keep up with ongoing costs. Now, your mortgage is just one part of what it costs to live in your home. You got your escrow account, which also holds your monthly taxes and homeowners insurance payments. So you need to make sure that those are being paid, or if you don't have an escrow account, you need to make sure that those are being paid on your own. If your home needs maintenance and repairs, budget and save for these too. 3, determine if you need flood insurance. 4, understand home equity lines of credits and refinancing, called HELOCs. And now you're on your way to being a knowledgeable homeowner.